Hey everyone, Mark Ferguson with Invest for More. Welcome to another one of Invest for More's real estate investing videos. Today, I want to talk about hard money, a little bit of private money, what it is, what it means, how to use it, and if it can be a good deal for real estate investors. Again, there's always much more information on investformore.com. I've got over 400 free articles now, and I have many other videos on my YouTube channel as well, so be sure to check those out. First I want to talk about hard money versus private money. Hard money lenders are basically companies, they're not banks. They're companies that find investors who will lend them money, maybe 8, 10%. That company turns around, lends that money to a real estate investor, either for flipping, for buying rental properties at a higher rate, maybe 12, 15%. The hard money lender will charge points as well, maybe 2 points, 4 points, even 5 points. And a point is basically a percentage of the loan amount. So if you had charged 2 points on $100,000, that's $2,000. So the hard money lender makes money by borrowing money at a lower rate, lending out to investors at a higher rate. Sort of like a bank, except hard money lenders aren't regulated. They're just a company only doing, they don't do residential loans, only real estate investment loans. So there's a lot of hard money lenders online. Many different states have many different hard money lenders, but there's also private money lenders that you see pop up advertising. We have private money. Basically, they're exactly the same as a hard money lender. They're just calling themselves private money to make themselves more attractive to borrowers who know how expensive hard money is. So if you're looking for private money is usually money you source yourself from friends, family, business associates, people you know who are going to lend you money for whatever reason at certain rates. If you find someone advertising private money online, it's not really private. They're advertising it to everybody. It's just kind of a hard money loan disguised as private money. So be careful that you're not thinking private money is much more than it really is when you find those companies online. So private money is another discussion. Today we're talking about hard money, but I just want to make that distinction. When you're looking online, looking at companies that advertise they have private money, it's probably just hard money in disguise. So when you're using hard money, there's a few companies that offer hard money loans in most states. I don't know if there's one that offers it in every state, but I know of a couple that offer hard money loans in most states. But most hard money lenders are very geographic specific. So, they might operate in just Colorado, or they might operate in just California. I know one company that operates in only Southern California. They don't operate in Northern California, just the southern area. Some companies might operate in, a 4-state region or a 3-state region. And then, like I said, there's 1 or 2 companies that operate kind of in 30 to 40 states and have wider base of products they offer. So when you're looking at hard money, many people think about using it for fix and flips and rental properties. So when looking at hard money for fix and flips, it can be a very attractive option, mostly because there's so few options available for fix and flip financing. When I finance my fix and flips, I usually use a local bank or private money. So I have an investor I know who gives me money. Very easy. I love private money because you don't have to go through any of the hoops or hassles or waiting time a bank has. But I pay, around 10% for my money when it's private. When I use my bank money, it's a local bank, local portfolio lender. I pay 5.25%, but they only give me 75% loan to value when I'm borrowing money. So I have to come up with down payment, repairs, carrying costs, all of that out of my own pocket. There's definitely advantages to both of those. Not everybody can find a local bank, a local lender that will finance flips. It's very rare. It's also not always easy to find private money, investors who may be willing to lend you money for properties. So what you're looking at for many people is hard money. And like I said, hard money is built for fix and flips. It's a short-term loan, usually 6 months to a year. They aren't underwriting the borrower so much as they are underwriting the property, making sure there's enough room to flip it, to make a profit. If something goes wrong, they want to make sure they can sell that property and still get their money back. The biggest turnoff to hard money lenders is their rates and fees. So typical hard money lender, I would say, is anywhere from 12 to 16% interest and 2 to 4 points. Usually, if you're just starting out, if you haven't worked with them before, you're going to be on that higher end, paying 15% interest, 16% interest rates, 2, 3, maybe even 4 points. It can get very expensive to fix and flip a house when you're using hard money. But if there's enough room in the property and you have no other options, it still might be viable to use a hard money lender, even though you're paying five, maybe even $10,000 more in financing costs. But I think there are some misconceptions about hard money with fix and flipping, in that you don't need any of your own money, you don't need any skin in the game. You can just go to a hard money lender. They'll be happy to loan you 100% of the deal, 100% of the repairs, and you're good to go. Hard money lenders are running a business. They want to make money, and they look at everything with risk versus reward, aspect. If they are lending money to a brand new fix and flipper who has never done a deal, never bought a flip, they are going to want them to have some money in the game. They're not going to go say, oh, sure, we'll lend you 100% of the purchase price and 100% of the repairs, no problem. They want to see you put money down. They want to see you put money down for repairs. They want to make sure you know what you're doing and you've done some deals first before they start making their terms a little better. So that's what you'll find too. If you work with a hard money lender, the more deals you've done, the more you can show how much you've been successful in the real estate business, the better the terms will be. Usually the less the points will be, the less the interest rate will be, and also the more money they will probably lend you. So if you work with the same hard money lender 3, 4 times, you have a track record, you've proven to them you know what you're doing, you're making money, then they might start looking at, okay, maybe we'll do less money down. At some point, maybe they'll do no money down and finance the whole deal if they're comfortable enough with you. But it's going to be very hard getting started as a flipper with no money, no credit, and expecting a hard money lender just to give you everything for it and just hope for the best. But like I said, hard money can be a great option if you don't have any other options, and you can still make money with flips considering the increased price and financing costs. Now, hard money for rental properties is a little different situation. With a flip, you're taking that hard money, you're buying the property, fixing it up, repairing it, selling it. As soon as you sell the property, boom, you can pay off the hard money lender. Many times the hard money lender won't want paid interest, or sometimes even the points, till after the house is sold. So the investor doesn't have to come up with all that out-of-pocket expense. It all depends on the hard money lender. They're all different. But with rental properties, some properties might need repairs, might not qualify for conventional mortgage, or there's some tricks on buying with less money down, using a hard money loan and then refinancing it into a conventional mortgage. So if you're a typical real estate investor trying to buy some rental properties, most of them are trying to use financing. Again, I use my portfolio lender. They're awesome. They don't care about repairs needed. Very easy to finance properties, 20% down. Not everybody can find that. And if you're trying to use a conventional mortgage, one where they want an appraisal done, they want to make sure the house is in livable condition, you might find some awesome deals that are well below market, but maybe they need a new roof, new furnace, plumbing's broken. It won't qualify for a conventional loan because the house is not in livable condition. You do have the option going to a hard money lender saying, hey, will you lend me this money 6 months? I'll buy the house with the hard money, use the hard money loan to make some of the repairs. Then, after the repairs are done, the home is in livable condition. I will refinance that hard money loan into a conventional mortgage, a longer, 30-year fixed, 15-year fixed, whatever you want to do, mortgage after you've made the repairs. That is one option to use hard money. That can be a great option. Some things to think about though when you're refinancing hard money is, so let's say you buy a $100,000 house, needs $10,000 repairs. Maybe the hard money lender loans you $90,000 and the $10,000 for repairs. So you've got a $100,000 loan with the hard money lender, $10,000 of your own money into it. Make all the repairs, get it all done. 6 months later, you say, hey, I want to refinance this loan. You have to get a new appraisal with a conventional mortgage, and with an investor loan, you're going to be putting 20%, maybe 25% down. You've got to make sure the home appraises for that new higher value to pay off all of the hard money loan. So you've got $110,000 into it with the purchase price repairs, $100,000 mortgage. If you're putting 20% down, you know that house has to appraise for the 125, maybe 130 range if you're putting more money down, so you can pay off all of the hard money lender. So usually if you buy a house below market value, you're making those repairs, the appraisal should come in okay if you bought it right, but something to remember. So one option that people do to try and buy with less money, even a house doesn't need repairs, is doing the same thing with a refinance of a hard money loan. So in that last example, you know, if you go in there with a conventional mortgage, say with my portfolio lender who doesn't care about the repairs, you buy the house for $100,000, you have to put 20% down. So I'm putting $20,000 down. Plus, I got my $10,000 repairs. Got $30,000 of cash into that property, you know, not including closing costs, some other things. With a portfolio conventional lender, could be an awesome deal still, but I've got $30,000 in cash. If we revisit that to the hard money lender into the refinance, then you've got that $100,000 loan you got from the hard money lender, you know, $10,000 of your own money into the property. 6 months later, house is repaired, you get it appraised again, it comes in at 130. Depending on what type of lender you use, you may be able to get a cash out, maybe not. We'll talk about that in a second. But if the appraisal comes in high enough, you can refinance that full $100,000 loan. So now all of a sudden, you know, you've only got $10,000 into this property in a $100,000 loan instead of an $80,000 loan. So there are ways to buy with less money down using hard money into a refinance. Some lenders will not refinance in 6 months, 3 months, and do it that quickly. They'll look at the lower of either your purchase price or any appraisal in the last year. But most conventional lenders doing a Fannie Mae mortgage will allow you to do a refinance as long as you don't take cash out. Without that seasoning period, you can do it right away. Get that $100,000 loan in place. Again, you're paying much higher fees, more points with the hard money loan, more higher interest rate with the hard money loan when you have it. And then when you refinance it, you'll be paying points again on the new conventional loan. So you're going to be paying, you know, $3,000, $4,000, $5,000 more in financing costs, but putting $20,000 less into the property. That's something you've got to weigh if it's worth it to put that much less cash in for the additional financing costs you will have. And finally, if you can find a lender who will say have a seasoning period of 6 months or no seasoning period at all, that means they will do a cash out refinance based on the last appraisal, even if you just bought the home 2 months ago for $50,000 less. So in that situation we just talked about, hard money lender loans you $100,000, you've got $10,000 of your own cash into it. Home comes back, you know, appraisal comes back $150,000. Like, awesome, you know, I really got a good deal, bought below market value. The new lender will do cash out refinance, no seasoning period, 20% down. All of a sudden, you're looking at a substantial loan that's higher than what you even paid for the property plus the repairs you made. So, I mean, you're looking at $120,000 loan you can get, and you've got $110,000 into it. So you've got your $10,000 cash back that you spent, plus an additional $10,000 that you didn't even, you know, have into the property. So now it's very risky to use that because you've got to make sure the home appraises for high enough. You can pay off the hard money lender. But I mean, in that situation, yes, you're paying $5,000 more interest, origination points, maybe more, but you got $10,000 back into your pocket for buying a rental property. Pretty sweet deal. Very, very important. Your numbers work, your cash flowing, and you really get awesome deals to pull that off. But it can be an awesome way to build your rental property portfolio without spending a ton of your own money. And again, it's going to be hard, very hard to find those lenders who will do a cash out refinance with no seasoning period. So you're looking for local lenders, credit unions, community banks, and you may have to call quite a few to find that. So don't expect just to call your local Chase Bank, Wells Fargo, and say you want to do a cash out refinance in a property you spot. It's not going to work out very well. So thank you for watching the video. Again, check out Invest for more information, and I will send a link to my hard money article in the comments below as well, which has a couple hard money lenders in it that I know of and work throughout the country. All right, have a great day.